Shares of UPS topping the tape today after the company beat on the top and bottom lines this morning. Delivery volumes increasing for the first time in 7 quarters. Earlier this week, Barclays downgrading the name to an underweight, saying long-term pressures from competitors could cause margin challenges. Joining us now is the man behind that call, Brandon Oglenski, Senior Equity Research Analyst at Barclays. Brandon, great to have you with us. We gave you props. That call, it's rare for Wall Street to go to effectively a sell rating and ahead of earnings, so that took a lot of courage. Where are you now? Because some would say that UPS just proved that the challenging times are behind it, that there's some sort of floor when it comes to the stock at this point.
Yeah, thank you, Melissa, and thanks, everyone, for having me on. And for sure, it's not easy to downgrade a big company to a sell, especially during earnings. But this wasn't really a call about their third quarter because they'd set up a pretty low bar and admittedly, stepped over it. But the question is about profitability going forward. And here's the challenge. And we like Carol Tomé at UPS. She's, an outsider that's running the company like the first CEO in their history. But the challenge here is that she's dealing with a unionized workforce, and Amazon is her largest customer. And so the challenge of that is they've had their cost base marked up with a new contract in the past year that's really pressured profitability. So her path forward is to say, let's take a lot of price. But the problem with that is when you take a lot of price, especially on an Amazon that has their own delivery network now that rivals the size of UPS, you just further incentivize them to insource even more of that traffic. So it becomes this negative spiral and feedback loop that I just suspect it's going to be hard for them to get back to long-term profitability targets.
I know you don't cover Amazon, but in respect to its delivery network, is it the writing on the wall that Amazon will eventually take all of that delivery volume back and put it into its own network, which it will grow?
Well, I'm not certain that Amazon can take it all back. There's certain things that Amazon can't do today, like they don't go both ways. They only deliver. Mm-hmm. So returns, when we return things, that usually goes through the UPS network. So that's still value add that UPS is likely going to offer for a long time. But the challenge here is, again, as they push more price, Amazon has a lot of ability to insource more of that. And it's really telling because Carol had an investor day in March and said, look, the glide down, as they call it in the Amazon business, had halted in March. She expected it to be roughly flat. But then this quarter, we learned, no, actually, Amazon insourced more of these next day air volumes. They're downgrading to ground. So that's still ongoing, even though we thought maybe it had reached a bottom.
So let me just switch gears a little bit. Operationally, they improved. That was good. But they talked about a little bit of softness or a little bit of moderating expectations for the fourth quarter. That's more broad. Does that weigh into your calculus at all or not really?
Well, for sure. That's more a near-term issue, and we saw it with FedEx last month. They had a pretty terrible quarter as well. Some of that is just macro because we're not seeing the industrial side of the U.S. economy really come through. That pushes a lot of urgency through the supply chain, B2B volume. So I think that's where we're not seeing the pickup yet. And definitely, UPS called out that some of their biggest retail customers said, hey, pull back in our peak expectations for the holiday period just a little bit.
A challenging stock without question, and I admire the call as well, and I think you're right that it wasn't about this quarter. This stock, if you pull up a chart, it's been in a downtrend for 3 years, lower lows, lower highs the entire time. Nothing has changed, but I guess my question to you is, at a certain point, we're going to wake up and say this is now a value stock. What is that point, in your opinion, price-wise?
Oh, well, that's a great question. I think in the low 100s, this becomes a very attractive dividend yield. And we're not saying that the dividend is not safe because they're covering the dividend. The challenge I have, at 130 or 140, which is where it's trading roughly today, you're not going to get a lot of dividend growth from here because what they did is they took the dividend up quite a bit during the pandemic when we had peak earnings, peak volumes, and now they're well above their payout ratio. And I know a lot of institutional investors own this in dividend funds that want to see dividend growth. So that's my fear, that at these levels, you're just not going to see the type of performance that you want. And I might even go just a step further, too, because FedEx is merging their package operations here in the U.S. It's a very important aspect to this story because this is a duopoly between the two of them. But for a long time, FedEx just never had the asset efficiency because UPS runs one truck, one network. Doesn't matter where the package is going. FedEx has always used 2 or 3. Now that they're merging those networks, you're going to get better asset efficiency at your closest competitor, and they're doing it without a union. So you need to think I'm sure you guys have looked at LTL, Old Dominion. We had Yellow go bankrupt, which was a Teamster trucking company, one of the last remaining in the LTL sector. Now it's UPS is the big Teamster operator, and they're going to go up against some very much more efficient non-union competition in the future.
We got to go, but did you get a call? Did you get a question on the conference call?
They did let me on.
All right, just checking. One if you got iced out.